Okay, well, thank you so much, Vitaly. All of you hopefully get a copy of the market perspectives, and this presentation here will be related to the perspectives quarterly that we sent out on July 5th. So we'll talk a little bit about the big surprise for the quarter, Brexit, and then look at some economic perspectives globally, look a little bit ahead, and then finally just try to sum up a couple of issues. So the quarter had a big surprise. It was, of course, dominated by this uncertainty, the British referendum to leave the European Union. But the vote to leave was a shock to the global political and financial community. Global capital markets instantly plummeted, and pound slipped to levels not seen for 3 decades. Governments, many companies, totally unprepared. And it was a terrific frenzy to confront this new political reality that will take some time to accommodate. And of course, we had political chaos in Britain. The Prime Minister decided to resign and was not going to continue in office. So the major political parties were in total disarray. The UK, as we know it, could end up not being part of what we know. Scotland and North Ireland really don't want to be part of a UK not in the EU. Millions have signed a revote for the internet. What did we do? I think is the perception of many people in the UK. Did we actually do something that was terrible to the country and to ourselves? The referendum is just an advisory thing, so it's not a legal commitment to formal exit, but I think the Europeans were not pleased, and Cameron decided he's not going to be part of it. And however, I think the majority sentiment, and finally, after some reflection, although there are parts where people do not agree, is the sentiment is against the EU immigration policies. That remains unacceptable to many, and the decision is really no fluke. Okay, so there is an interesting side note here. Again, well, did the electorate get duped? Was there this widespread sentiment that maybe we did something that we shouldn't have done? Boris Johnson, the mayor of London, who led the Leave effort and was going to be the prime minister, decided afterwards that he's not up to the job, and he withdrew. And he was the focus of much anger. He poses as a charming and very witty buffoon. He has a long history of not paying much attention to facts or its consequences. It was, in one particular memorable case, he was trying to make the case of how onerous the EU's regulations are to the poor British. And so he had an example where the EU had a law that balloons cannot be blown up by children under 8. It's kind of funny, but the consequences were that he led the country to the greatest constitutional crisis in peacetime, and he no longer wished to be involved. So what's happening to the UK? Well, short term, obviously, the UK economy has been devalued significantly. A sharply devalued currency. Prices will increase. There'll be contraction investing in hiring, and the whole issue of how to trade with the EU is totally up for grabs. On the other hand, the UK has continued to have its own currency. The Bank of England continues to be independent of the EU, and so it can reposition itself as a global trade partner. It always has been in history, and for the long term, there are many possibilities for the UK. Okay. What about the U.S.? To some extent, it's largely a non-event because the U.S. economy has weathered many disruptions since the Great Recession and continues to put along in its own deliberate, slow growth way. But unemployment now is pretty low. Interest rates are very low. Consumer confidence has been up. The wage growth has been signs of accelerating. Higher retail sales, oil below 50. The Federal Reserve seems to be pretty committed to its positions and has done well. The markets have been very resilient. We are a global safe harbor for all investors. So that unfortunately means a strengthening dollar. But the prospects remain for slow growth and a very looking over their shoulder weary Fed. Brexit may have the most serious consequences for the EU. That is actually my view. There's been a lot of dissatisfaction in the EU people, not the ruling people, but not the politicians, but the actual people in the street, in terms of EU immigration and regulation policies mandated by Brussels. There's a lot of political destabilization across the entire spectrum of politics in the European Union. There continues to be a lot of uncertainty about how effective the stimulus policy has been, and that is even more uncertainty than it used to be. There's lots of questioning of the European experiment and a nagging sense that the EU ideals of the European Union maybe just simply do not work in practice. In Japan, Brexit led to strengthening the yen. That was the last thing they really needed. Industrial output was falling with inventories rising, very reduced exports as a consequence of the strengthening yen. And there are just a lot of things going on in Japan that for some reason, for many reasons, just the economic policies and the stimulus package of what's called Abe economics, that doesn't seem to be working very well. There's a lot of cultural rigidity in Japan, high savings rate, little incentive to spend, and of course an aging demographic. In China, Brexit disrupted Chinese monetary policy because the currency needed to be devalued. Chinese monetary policy is focused mostly on managing economic growth via the currency. And the yuan now is much lower than it has been, low to the extent they're even at 2010 lows. And a strengthening dollar relative to the yuan encourages capital flight, something that the Chinese authorities hate, and limits their ability to manage the economy. Also, there was something that happened this quarter that's important and notable. MSCI decided not to include local currency equities in its benchmark. So that really disappointed the Chinese authorities greatly. This is just an example, however, of a lack of transparency and financial maturity in Chinese markets. Emerging markets has been a little bit better. They have performed sort of okay recently, year to date. Oil prices have stabilized, and in some cases there's a focus on corruption and dysfunction that has not been there before. Economic pain can sometimes lead to reforms. So just a couple more comments here as we look ahead. For the U.S., it's a very different world than for others. We're going to be dominated by presidential and congressional elections, and so we'll have media saturation on this every night. Lots of pundits having great things to say, and I recommend that everybody take a long summer vacation if possible, and to avoid all of this if possible. There is a superficial resemblance to the UK in terms of the political issues. But it depends on your perceptions of what you mean by resemblance. The Fed is definitely in a wait and see as far as rate increase is concerned. The U.S. remains in a slow but steady growth path. And one thing to say is that even if capital markets are not performing that well, although they have been, there's also for the individual that's not necessarily investing greatly, there's enhanced purchasing power, and that's really making people feel better in terms of the effect of a strong dollar, low interest rates, and cheap oil. Look ahead for the UK. I kind of feel that there's been a venting of animal spirits here of a disconnected political class. There's a great deal of classes issues in classism in the UK, and I think it just came to a boil in this referendum. But the cheap pound encourages exports and can be helpful in reviving some industries that have been dormant as a consequence of their relationship with the European Union. So over time, there could be an economic resurgence, a strong trading ties. The UK has strong trading ties well beyond Europe. But however, London's financial dominance may be impacted. And for the European Union, again, back to my theme earlier, this Brexit storm seems fairly ominous for the European Union. There's a lot of uncertainty. There's the economic burden of more than 1 million migrants, and how do they get assimilated? There's no unified banking system. There's very little political will. There's enormous persistent unemployment and deflationary pressures in many parts of the Union. There's a lot of questioning of austerity policies, and there's a serious reassessment that I think is going to be required, and that will take time to sort itself out. Finally, and this is a maxim of modern finance, political risk is the single most important capital market risk, and this is what we have seen here. The UK is going to necessitate a reset for the global economy. While global capital markets, with some exceptions, have returned to near Brexit levels, the resentments that have surfaced and the policies imposed by a disconnected political elite from Brussels has made a big impact on economic value here and will continue in the future. And by the way, this may be similar to how people feel in the United States, but it's certainly a lot more related to Brussels and then, of course, to London as well. So these social, political, economic issues are not only confined to Europe. A lot of people are wondering about the benefits of globalization. The central banks are right now not competing, but they could be, and they're wary about each other. However, money has to go somewhere, and if you have very low yields and very low inflation, what happens to equities? Well, the equities might, in fact, be benefiting from no other place to go.